Yang berbahagia Datuk Shaik Abdul Rasheed Ghaffour, Deputy Governor Bank Negara Malaysia, and Sri Dato, distinguished participants, ladies and gentlemen. I'm very honored and delighted to welcome here the Deputy Governor of Bank Negara, Datuk Shaik Abdul Rasheed Ghaffour, for taking time off your very busy schedule to be present with us this evening to deliver the closing address at the Malaysian Banking Summit. Thank you, Deputy Governor, and thank you to Bank Negara for supporting this event. May I just very briefly introduce the Deputy Governor. Prior to his appointment as Deputy Governor, Datuk Rasheed served as the Assistant Governor for Monetary and Economics in Bank Negara. He was seconded to the International Monetary Fund, IMF, as alternate Executive Director for Malaysia and the Executive Board of IMF, and Datuk Rasheed has served in Bank Negara for over 20 years and has been involved in the key areas of central banking, including policy formulation, financial sector development, financial surveillance, and prudential policies for the banking and insurance sector. Datuk Rasheed obtained an honors degree in economics from the University of Malaya and an MBA from the University of Oxford. We are honored and delighted to welcome here Datuk Shaik Abdul Rasheed Ghaffour, Deputy Governor of Bank Negara. Over to you, Datuk.
Thank you very much, Tan Sri, for the very kind introduction. Bismillahirrahmanirrahim. Assalamualaikum and a very good afternoon. Tan Sri Michael Leo, President of the KSI Strategic Institute for Asia Pacific, Datuk Wazir Hassan, Executive Vice Chairman, KSI Institute, and Tan Sri Abdul Wahid Omar, Chairman of the Advisory Council Economic Club of Kuala Lumpur. Thank you for inviting me to deliver the closing remarks at the 2021 Malaysian Banking and Finance Summit. While most of us would have liked to gather in person today, I'm grateful that we are still able to connect virtually. Congratulations to the organizers for a successful event. Since early 2020, the COVID-19 pandemic has impacted our lives in unprecedented and profound ways. We have had to learn to live with disruptions and to find new ways to work and interact with each other. The financial industry has also experienced other forms of disruptions, especially over the past 5 years. This includes the increasing pace of digitalization, new business models, and evolving consumer preferences. Like the uncertainty brought upon by COVID-19, the path ahead for the financial sector will also have new and unpredictable challenges. The key point is that we must be prepared for a world where change is the norm. Against the backdrop of a public health and economic crisis of this scale, the financial sector is now presented with a once-in-a-generation opportunity to mold the future of finance. As history illustrates, this opportunity is no different from what we have seen in the past. About a century ago, the West emerged from the rubble of World War I and the Spanish flu to a decade of accelerating economic expansion, a period known in America as the Roaring Twenties. The renowned economist John Kenneth Galbraith described the stock market boom in the 1920s as fueled by activities in financial markets and innovations in new financial products. With lackluster financial regulation in America at the time, these developments left the economy vulnerable to adverse shocks. Indeed, the ensuing Great Depression saw real gross domestic product falling by an unprecedented 30%, sending the unemployment rate soaring above 20% at its highest point. The Great Depression was the longest and most widespread economic crisis of the 20th century. A century on, and with the benefit of hindsight, the financial sector can and must surely do better in balancing development and risk. Banks, who have been a source of stability and support during this COVID-19 pandemic, now have a unique chance to rethink financial services. We must ensure that progress and transformation is inclusive and sustainable, while not posing undue risk to financial or economic stability. Today, I would like to share how the financial sector may strengthen its role now and in the future in a responsible and sustainable manner. In his opening keynote address, Yang Berhormat Minister of Finance spoke about the 3 Rs, which are the focus of the budget 2022. I would also like to reference the same themes. This demonstrates the importance of ensuring a coordinated approach towards ensuring progress in our economy and society at large. The first is resilience. Here, we consider how the sector can support the economy and the rakyat during the most challenging times. And this is followed by recovery, how banks can play a role in safeguarding the healing process amid an environment of risk and uncertainties. And third is reform. Going beyond immediate priorities, we turn to longer-term strategies that the industry can undertake to accelerate digital adoption in financial services while finding a sustainable and inclusive future. On resilience, our financial sector has been proven to be resilient in this crisis. Like other countries, Malaysia was adversely impacted by the COVID-19 pandemic. Our economy contracted by 5.6% in 2020, the weakest performance since the Asian financial crisis. The unemployment rate reached a high of 5.3% in May 2020, a level not recorded since the late 1980s. However, a strong fiscal, monetary, and financial policy responses cushioned this economic shock. Despite the reimposition of stricter nationwide containment measures in the middle of this year, the economy continued to be on its recovery path, driven by improvements in domestic demand and continued robust exports performance. For 2021, the economy is expected to record a growth of between 3% and 4%. A key success factor to this is the coordinated and consistent policy response by the government and the banking industry, particularly in offering relief facilities and loan repayment assistance to affected individuals and small and medium enterprises. In April 2020, Malaysia was one of the first few countries to implement an automatic moratorium for all bank loans for a 6-month period. Recognizing the ongoing challenges faced by borrowers, from July 2021, the banking industry has continued to make available the 6-month loan moratorium to assist all individuals, micro enterprises, and affected SMEs. As of August 2021, the total individual and SME loans eligible for the automatic loan moratoriums account for close to 1.4 trillion ringgit, or about 73% of total banking system loans in the country, benefiting more than 2.6 million borrowers in Malaysia between 1st June and 20th August 2021. In terms of scale and scope, the measures introduced in the last 1.5 years have been among the most extensive offered by any country. With a high level of strength and stability of our financial sector at the onset of the pandemic, the banking industry has been able to step up when we needed it the most. As the world gradually reopens and vaccination rates accelerate, there is reason to be cautiously optimistic. Yet, the battle against COVID-19 and its variants is not over. The banking industry will need to be proactive and ensure that it continues to build the capacity required to extend support to borrowers who need help in a timely and efficient manner. This includes extending new financing to support the economic recovery as more businesses are allowed to resume operations. Since the structural reforms of the post-Asian financial crisis era, banks have been a source of stability and strength to the country. This must continue, even as banks contend with the long-lasting effects of the pandemic, including the potential double whammy of reduced income and higher loan defaults by individuals and businesses. Moving on to the second R, or recovery. Many of us have come to terms with the realization that COVID-19 is here to stay. Instead of aspiring for a future where the virus is completely eradicated, we should begin to adapt our activities and behaviors to turn COVID-19 into a manageable risk. From both the economic and public health perspective, the risks of not doing so are too costly. There are encouraging signs where this adaptation is taking place. For example, fully vaccinated individuals are now able to participate in a wider range of activities, subject to compliance with strict standard operating procedures, bringing about much needed relief to businesses. Further arrangements are also being explored, including cross-border travel bubbles within ASEAN and collaboration on mutual recognition of vaccination between regional countries. This progress is certainly encouraging, and I believe that the financial sector will play a pivotal role to safeguard Malaysia's ongoing healing process amid the complex challenges ahead. While there may be several paths to the recovery, let me share perhaps 3 ways forward. First is that the banking sector should continue to ensure access to financing to those who deserve it. As I mentioned earlier, banks have responded to this call admirably. At the end of second quarter of 2021, outstanding loans to both the business and household segments increased by 1.3% and 5.3% respectively, as compared to the same period last year. But the job is definitely not done. Banks must continue to strengthen their counter-cyclical role to support the economy by continuing to finance viable but distressed borrowers. Bank Negara will continue to assist the industry by providing support in various areas, including through dedicated funds that offer financing at concessionary rates for banks to on-lend to consumers. Second is that the financial industry should seize this opportunity to contribute to the recovery process and broader reform agendas of the nation. The pandemic has underscored and exacerbated some of the deep structural issues in the economy, especially in the labor market, where more vulnerable workers have been affected. As the economy moves into the recovery period, policies should shift from job preservation to job creation. Banks can contribute through the provision of financing and also support through other ways. A key reform area, for example, is the implementation of active labor market policies by the government to improve the overall social protection framework. This is aimed at enhancing the employability and income potential of workers. In many countries, these are primarily market finance. Banks can seek out opportunities to support these policies, which would alleviate the fiscal pressure on the government. In addition, banks can lead by training and investing in upskilling and development to prepare a workforce that is ready for the future. Third, banks must focus on sustainability as part of efforts to promote economic recovery, in line with the global focus to achieve a balance of economic, social, and environmental progress. Bank Negara, in partnership with Securities Commission and the industry, has continued to lead collective climate actions through the Joint Committee on Climate Change, or the JC3. And I'm pleased to note the progress made by the JC3 so far, notably on the establishment of the Climate Change and Principle-Based Taxonomy Implementation Group to ensure a successful implementation of the taxonomy, the plans to support climate-related disclosure by financial institutions, and the collaboration between key public and private sector partners to address critical data gaps for climate risk management. Banks have a core role to play in the transition to a greener economy. For example, inclusive circular economy solutions and business models, seen as a critical piece for sustainable development, are still considered a high-risk venture for financiers. This is an opportunity, actually, for the banking sector to work closely with relevant stakeholders, including policymakers, to develop new and innovative financial instruments that de-risk circular economy investments while ensuring that the right incentives are in place for better public-private partnerships. An example of such instrument is blended finance, which is the emerging as a promising approach to unlocking commercial finance consistent with the desired development goals, that is to build circular economy innovations and businesses at scale. Let me now move to our final R, that's the reform part. I would like to focus on 2 major trends relevant to the banking sector. First is on digitalization, and second is on funding the future economy. Today, increasing digitalization and emerging new business models are reshaping the very identity of the financial sector, as shown by changing consumer behavior, the blurring of boundaries within and beyond the financial sector, and even in the way we interact with finance. The rapidly evolving landscape brings with it a host of opportunities, including lower cost of financial services, more tailored and convenient financial offerings, and a greater ability to reach underserved and unserved segments. Reflecting on these opportunities, the reality is that the lines between technology and finance are increasingly vague, with marketplace innovations leading the way. For example, new financial players such as big tech firms have been able to enter financial services and scale rapidly by harnessing their user data and leveraging network effects. A similar scaling up can be observed in the adoption of stablecoins, with the economists estimating that the market capitalization of stablecoins has increased by more than 7 times in just a year, from about US $14 billion in August 2020 to over $100 billion in August 2021. And in a more esoteric corner of finance, the emerging trend of non-fungible tokens or NFT since late 2020 has led to a democratization of finance of sorts that may have implications on traditional finance intermediaries. When we take a step back, these technology-driven developments, including the broader trend of global stablecoins and decentralized finance or DeFi platforms, may seem relatively nascent in the context of the existing financial sector. But yet, these developments will have profound implications for regulators and more broadly for the financial sector. Central banks, including Bank Negara, we are mindful of these complex challenges, even as we anticipate the opportunities that lie ahead. On 2nd September 2021, Bank Negara announced that we will join forces with the BIS Innovation Hub, the Reserve Bank of Australia, Monetary Authority of Singapore, and South African Reserve Bank to test the use of central bank digital currencies or CBDC for international settlements through Project Dunbar. This proof of concept is a key part of our journey to build internal capacity and understanding on emerging technologies to facilitate the future-proofing of our key payment infrastructures while addressing existing gaps in cross-border payments. At the same time, Bank Negara is committed to foster an enabling environment for data sharing in the financial sector. We will focus on developing common standards for high-impact use cases and strengthening the digital data governance framework to ensure the protection and fair treatment of financial consumers. We are also actively collaborating with other stakeholders, including the government and industry players, to enhance accessibility to public data under the government's open data initiatives and to contribute to the development of a robust data protection legal framework. The Ministry of Health's recent launch of COVID Now, a one-stop portal for COVID-19 data, is a good example of moving forward towards data-driven policy decisions. Importantly, the initiative, which has received encouraging feedback so far, demonstrates that public-private partnerships are possible and in fact much needed. Similarly, the banking sector should make the most of the progress in the data ecosystem to further advance financial inclusion, to empower consumers to make informed financial decisions, and to develop innovative financial solutions that benefit the rakyat as a whole. Let me move on to the second part on the funding the future economy. Equally important for sustainable reform is to ensure quality investments and innovation-led growth. Some promising steps have already been taken, for example, in the development of the National Investment Aspirations, or NIA, a forward-looking growth framework that serves as a basis for Malaysia's investment priorities. The NIA is expected to propel longer-term growth for Malaysia through the sustainable quality investment in new and complex growth areas. At Bank Negara, we have established a 1 billion ringgit high-tech facility on national investment aspirations under the Bank Negara Funds for SMEs program for businesses affected by the pandemic. And this is to preserve Malaysia's competitive positioning in the global value chain, while at the same time safeguarding high-skilled jobs. While the unprecedented policy response by the government has been key to limit the economic fallout of the pandemic, an over-reliance on a debt-based recovery will lead to significantly financial stability risks. Therefore, banks should seize this moment to offer new forms of financing and to improve understanding of new growth areas, including those aligned with the NIAs. Innovative alternative financial instruments, whether based on debt, equity, or even invoice-based financing, will be critical in meeting the needs of high-growth businesses across various phases of the firm lifecycle. I would strongly encourage banks to continue to work closely with the ecosystem players, including market-based financing entities, industry players, and regulators in this journey together. Let me conclude with the words of Soren Kierkegaard, a Danish philosopher and theologian. Life can only be understood backwards, but it must be lived forward. Turning back the pages of time is necessary to understand it and learn from mistakes. Yet, even as we seek to move forward, we are confronted with the reality of a complex and rapidly evolving world. Looking ahead, I'm pleased to share that we are in the advanced stages of developing the upcoming financial sector blueprint that will set the vision for the financial sector for 2022 to 2026, which will be launched early next year, inshallah. The blueprint will also emphasize the importance of market-led development. Given the increased level of maturity and development of the financial sector, we believe that it is an important time for industry to be at the forefront and to play a bigger role in defining the future of the financial sector. Before I end my remarks, let me emphasize, I'm excited for the future of the financial sector. It is now more than ever that the financial sector should turn crisis into new opportunities with the 3R strategy to build a more inclusive, resilient, and sustainable future for Malaysia. With that, thank you very much.